Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Andrew Fennell, head of Greater China Sovereigns at Fitch Ratings. Today, I'm pleased to introduce Jean Ma, who serves as a head of China research at the Institute of International Finance, where he maintains regular contact with Chinese financial institutions and policymakers. Prior to joining the IIF, Jean has also covered China's economy for the buy side, sell side, and at independent research houses such as Tudor Investments, CITIC Securities, and ISI Group. Jean, thanks for joining the podcast today.
Thank you.
Before we dive into the focus of today's podcast, which is your outlook for the Chinese economy, I wanted to start with a bit of a more general question about the Institute of International Finance. So to get started, would you mind giving us a quick introduction to the history and perhaps the mission of the Institute of International Finance and the role it plays in the financial services industry today?
Yeah, certainly. IIF is a trade association representing about 400 financial service firms in about 60 countries across the globe. It started in the 1980s to help solve the Latin America debt crisis by providing the macro research, also served as a bridge between the banks and the policymakers. Right now, besides macro research, we also help with the communication between member firms and also regulators, also serve as a gathering place for all types of financial institution service firms to learn from each other and help each other.
Thank you for that introduction. And I guess now let's dive into the topic of the day. The sudden end of the zero COVID policy in China in late 2022 has dramatically altered the economic landscape across the country and prompted many forecasters to upgrade their baseline projections for this year, including us at Fitch Ratings. So maybe just to start, in your view, what stage in the post-pandemic reopening process does China's economy find itself at the present time?
Yeah, it is indeed a quite amazing process. We all know Beijing abandoned zero COVID policy in early December last year. And now researchers estimated about 1 billion people got infected in 4 or 5 weeks at times. This is probably the largest mass infection in human history. At the beginning, people were very concerned about new variant and other consequences. But very luckily, so far, there's no new variant found. And also, in early January, Korean authorities said about 80% of arriving passengers from China test COVID positive because they do test arriving passengers at the airport. So in the 3 weeks ago, published another data set now said that this number that tested positive dropped to almost zero. So which means the herd immunity was at last achieved. So even China CDC 2 weeks ago announced that the COVID pandemic was basically over. So what a saga. So now it's time for us to take a serious look into the implication of the reopening to the Chinese economy and also to the global economy. So right now, the first the data point we can collect is the consumption data during the Lunar New Year. So if you look at the number for travel, restaurant, movie ticket sales, they basically recovered to about 80% of the pre-COVID level. There's still a gap. That is because people back in January, late January, early February, people have had a little bit lingering fear of COVID. So I think right now the economy is still recovering. Still has not reached its potential. But at the same time, there are also some secular headwinds ahead.
And just to clarify, I mean, first and foremost, it's very interesting. I think after the China CDC stopped publishing the infection data, it's interesting that people have been very clever in finding other ways to track the amount of infections. And this, I guess, cross-border data is very fascinating. And I guess that clearly shows the outbreak is over. Is that basically your understanding at this stage?
Right. When we don't have the data coming out from Beijing, we know the airports in Tokyo, Milan, and Seoul, they do test the arriving passengers. So that's something data we can look into. So fortunately, none of those foreign authorities announced they found any new variant.
Interesting. Okay. So I guess, it's on to discussing the near-term prospects for the recovery. And I know that you've participated in this debate about consumption. There's quite a lively debate in the markets right now about what the pattern of consumption in China is going to look like this year. And some are arguing that there's going to be a tremendous amount of quote unquote revenge consumption because of the uncharacteristically high surge in bank deposits that people have recorded and noted. What is your own view on the potential path for consumption in China this year? And are you of the view that there will indeed be a lot of revenge consumption in the horizon?
First of all, it is pretty straightforward. There will be a strong rebound in consumption. But however, I think the consumption will be pretty narrow. And the spillover in other countries probably is quite limited. First, so not all the lost consumption can be regained, right? And you may want to have a revenge in terms of traveling, but you will not have another meals to compensate for the meals lost last year. So that being said, we do expect robust consumption recovery due to high income, better consumer confidence, and a very low base a year ago, and also some excess household saving deposits. So just want to remind you, last year, the growth rate household consumption was only was a negative 0.2%, so basically zero. So that's why the base was very low. Also, last year, people spent less money from their income, which means the consumption propensity was also very low. A higher propensity to save and lower propensity to consume. I hope this thing will also reverse in 2023. And on top of that, we noticed Chinese household put about 18 trillion yuan into bank deposit last year. It's a huge amount of money. That's 80% higher than the year before, than in 2021. And so that's the flow, the new addition in last year. If you look at the stock, then the total stock of household deposits in banks reached about 120 trillion at the end of last year. That's exactly the size of the GDP. That's about 85,000 yuan per person. That's roughly about 200,000 yuan deposit per family. Of course, we know these money are concentrated in relatively well-off families, distribution not that even. But nonetheless, this amount of deposits is about 20 trillion higher than the number predicted by the trend line. So this we can call this excess saving, excess deposits. So this is the fuel for consumption in 2023. Of course, not all of those money will be spent, right? But we need to know where this money came from. And Chinese households put more money into bank deposit because they didn't buy as many homes as they used to. And also they pull money back from risky financial assets, put them in the safe bank deposits because they became a lot risk averse because they risked off last year. So some money will stay as a saving, will not get spent, but nonetheless provide the resource for the households for higher consumption spending in 2023.
I wanted to pivot a little bit to a bigger picture question, which is one of your latest research notes. And I noticed that you've adopted a somewhat guarded tone in writing about China's 2023 outlook, evident from the title, which I quote, "Headwinds Against a Sharp Growth Rebound." So with that in mind, would you mind just walking us through your 2023 growth forecast and elaborate a little bit further on your rationale for being positive, but a little bit cautious in that positivity?
Right, and we do expect China to grow by about 5.3 to 5.5 this year. Now, this sounds kind of paradoxical. It seems a pretty high number. That's why you say there are a lot of headwinds. Yes, say 5.5 sounds a pretty high number, but remember, the growth last year was only 3%. If you did a 2-year average, so there's barely above 4% a year on a 2-year average term. So that means the growth rate is still below potential. So that's not a spectacular growth rate. And also, we expect growth to be very backloaded this year. That means if you look at sequential term, okay, not year over year, but sequential term, it will grow about 1% sequentially in the first half, and about 1.5% in the second half. But of course, remember, the second quarter last year was particularly bad due to Shanghai lockdown. So that was a crater in 2Q last year. So you may see a pretty high, so almost 7% a year-over-year growth in the second quarter. But don't be fooled by the year-over-year number, which is influenced by the low base effect. But if you look at the sequential growth profile, it will be very much backloaded this year. Now, the reason we'll also at the same time want to have a little bit cautious note is that we do see a lot of headwinds this year, secular headwinds. The very first one is trade. We do see China's export growth is deteriorating very quickly. The China export grew about 15% in the first half last year. That was negative 10% in December. Okay, that's how fast the export is falling. And also, you may see some news reports showing the picture of empty containers just piling up in the Chinese ports. We're still trying to figure out what's happening, but very likely the slowdown in the global economy, in the Eurozone and in the US, will dampen the demand for export from China. And also, supply chains get disrupted, and a lot of the export manufacturing relocated from China to other ASEAN countries. The U.S. technology sanction and special chip embargo may also hurt China's production and also the export of technology products. So for example, the export of Huawei mobile phone, right, basically just disappeared because cannot use the U.S. chips anymore. So these have a heavy imported components. So that's why we expect export to slow from 7 last year to about 0, or maybe even slight negative growth in 2023.
It sounds like we're in a little bit of a catch-22 because on the one hand, I think people around the world are looking at China's reopening and are hoping that that's going to offset the downside pressures to the global economy. And on the other hand, we're looking at these weak trade figures coming out of China. What do you make of these two dynamics going on at the moment?
Well, the economies are always intertwined, right? And so they do depend on each other. When China can grow in, say, 5 and 5.5, in the accounting sense, it can make pretty large contribution to GDP growth because China GDP is about 18% of global GDP last year. Okay, so if 18% of global GDP can grow at about 5.5, that's almost 1 percentage point contribution to global GDP. However, that's a contribution in accounting sense. Okay, it doesn't mean that it can pull up the growth rate for the rest of the world. And for China to pull up the growth for the rest of the world, we need China to import more. Unfortunately, at this moment, with the deglobalization force and also the nature of China's recovery this time, we're afraid such a spillover can be pretty limited. It will be much smaller than we saw in 2009 and 2010 when China's $4 trillion stimulus created the commodity supercycle. So those days are probably gone. We can go into a bit more details later.
Okay, sure. I guess one other key area of uncertainty, which is being actively debated, is the possibility of a earlier than expected turnaround in the property market this year. There's a lot of different polarized view on this at the moment, and I think the dynamics are changing quickly. But what is your take on this? I mean, will improved consumption patterns this year be sufficient to rebuild homebuyer confidence and ultimately boost the property market again?
Yeah, that's a huge deal because the real asset sector is directly a quarter of China GDP, indirectly a lot more. And China's housing market used to be incredibly resilient, able to bouncing back quickly once the policy turned more supportive, and the home price can bouncing higher than before every time. Again, this time probably different. Beijing policymakers already made a U-turn in the housing policy. The so-called 3 red lines that limited the developer leverage has been abandoned or no longer a binding constraint anymore. The developer now offers so-called 3 arrows, which is the financing through banking loans, onshore bonds, and equities. So I think the developers can take a break get a lifeline. But however, the home buyer confidence is still very weak. So for example, the PBOC survey came out in the fourth quarter showing the number of households plan to buy a home in the next quarter is still at a record low. So that is because the whole housing cycle probably peaked measured by different variables. For example, if you look at the marriage rate, the formation of household, the housing inventory, they are all probably peaked. And also, if you look at the average living space of Chinese residents, they are above the global average. So that's why when people do not expect ever grow higher home price, they probably will be a lot more cautious for home purchase.
So it sounds like, if I read between the lines, perhaps there is a debate about a near-term cyclical recovery, but it sounds like the message that you've put out here is that you see longer-term a structural slowdown.
There is. So on the bright side is that a financial crisis can be avoided because the developers are giving them a more credit line. But on the activity side, I think the housing market and construction probably in a doldrum for a while, so will not contribute to much economic activity. Now, one more data point: so Chinese developers were cutting their housing starts by 40% in 2022 and 44% in the fourth quarter. So with the housing starts, say 40% lower than year before, the whole construction activity in 2023 will be very much muted. Also, land acquisition is also only half in volume than a year before. So both in terms of land purchase and a new start, the activity level is only about a half than a year ago. So in 2023, the housing activity may stabilize. That means the growth rate move from negative 40% to zero, but it's hardly a stimulus.
I guess somewhat unrelated question, but is a topic that's come up a lot of very often with our conversations with investors, is the one of inflation. And many people do seem weary that we could see significant upward pressure in consumer prices this year, partially because of the recovery and the pent-up demand for consumers that we discussed earlier in this conversation. How do you see inflation dynamics at present in China? And do you think that some of these concerns about a spike in consumer prices are warranted?
I think in the near term, we still see a bit higher consumer inflation because of a strong consumption. But if you look out a few more years, we still see a very strong deflationary forces in China. So yes, the CPI was only about 2.1% in 2022, and it may move toward 3% this year. That's it. Yes, consumption is strong, but at the same time, there are a lot of mitigating factors to cap the consumer inflation in China. First, there is no visible constraint on the supply side. The capacity utilization of the manufacturing sector last year was only about 76%, which is pretty low. The unemployment rate is still at 5.5% in January, which means there's still some slack in the economy. And the global slowdown and decoupling also reduced the demand for consumer goods export from China, and also trade headwinds offset high domestic consumption demand. Moreover, even though there's a high correlation between China and the global PPI, the correlation between China's CPI and the global CPI used to be pretty low. So that means China may not be that inflationary for the global economy this year. And also, we can ask this question. So in the past 2 or 3 years, China's a very weak economy, and the deflation in China during COVID lockdown didn't help dampen the global inflation. And why should we expect China reopening and it must be inflationary this time?
Okay, so perhaps we get a bit more inflation, but still below 3% in your view for this year, which is, I guess, a pretty reasonable outcome.
Yeah, also the spillover is pretty limited.
Okay. Well, I guess this transitions pretty neatly into the macro policy outlook. It sounds like inflation probably will not be a constraint on policymakers' decisions in terms of how they want to pursue different policy settings. So last year, monetary policy was mildly supportive. I guess we had two small cuts to the required reserve ratios for banks and to the de facto policy interest rates. In our own view at Fitch, where we do sort of a consolidated fiscal balance, we thought that fiscal policy was quite accommodative, especially through the channeling of infrastructure investment through the local government special purpose bonds. How do you see the key priorities for Chinese policymakers this year, which is, I guess, as we've been discussing, a year of recovery? And how does that inform your outlook for monetary and fiscal policy settings?
Yeah, this is a transition year for Beijing policymakers. Premiership, bank and security regulators, and like the PBOC governorship will all be replaced next month. And in mid-March, in the People's Congress session, we'll see the new lineup of the Beijing economic policymakers. So right now, we're hearing very little of new policy ideas from the outgoing administration, and we'll hear a lot in March and early April. So I expect monetary policy will shift towards more neutral in 2023 in view of better growth and higher inflation. More expansionary fiscal policy is still needed at this moment because the Chinese economy is still growing below potential, the unemployment rate is still elevated. But however, the local government already have it in debt. It's hard for local government to borrow further. So we should expect a central government to do more heavy lifting. So we expect a fiscal deficit will remain sizable in 2023, but maybe somewhat smaller than in the COVID years. So which means there's no strong monetary or fiscal stimulus this time. So that makes this recovery very different from the global financial crisis stimulus years. That also we expect spillover from China to the global economy is very disappointing. So what do Beijing policymakers do this time? We expect policymakers this time will focus more to reboot the business confidence through selected deregulation and also phasing out previous very draconian regulatory policies. So for example, they made an announcement that the shakeup of the internet platform monopoly is over. Okay. Even the Didi, the hailing firm, now is allowed to promote the app and adding customers again. So that's probably is the policy focus in 2023.
Interesting summary. So just to recap, monetary policy, you think will pivot towards a neutral stance, and then we'll still get some fiscal support, but not as much as last year. I guess I would be remiss not to ask you at least one question about capital outflows or capital flows in general, which I understand is one of the IIF's areas of expertise in the financial services industry. So against the backdrop of Sino-US geopolitical tensions and what you just alluded to, which was a bit of heightened business uncertainty in recent years, it appears that many global investors did cut their exposure to Chinese financial assets. And there was a lot of debate last year about whether this would become a permanent trend or was it just a purely transitory trend. So I know you've looked into some details in the recent swings in China's cross-border portfolio flows, and I'd be curious to hear what your views are. Are you seeing a recovery in portfolio inflows now that China's reopened the economy? And what is your take on what transpired last year in terms of global investor positioning towards China?
Yeah, China saw a record outflow of $93 billion of bond investment by foreign investors last year. This largest ever. So it was a popular view that Chinese asset became not investable due to China's close tie to Russia and the risk over Taiwan Strait. So it's a tricky issue. So I took a closer look. The more detailed data may say otherwise. It's still the cyclical factors such as Fed hike, China's own economic woes, and the policy blunder and reversion of the U.S. and China yield curve these still play a much big role than the geopolitical risk. Geopolitics still exists, but not a dominant factor. I'll give you a couple reasons. If the capital outflow from China last year was indeed due to geopolitics, then we should see the outflow of both fixed income and equity money, right? The fact is that we saw an outflow of $93 billion in fixed income, but a net inflow of $13 billion last year in equities. Okay, so obviously the portfolio outflow was mainly driven by fixed income, not equity. Equity was an inflow. And a second, so if it's only driven by geopolitics, then we should see the outflow by only foreign investors, not the Chinese-only investors. But the truth is, the domestic Chinese investor also allocated a record $120 billion abroad in foreign bonds. Okay, so obviously this was driven by higher foreign yield last year. And also, if investors are really spooked by the risk over Taiwan Strait, and they investors dumped assets from both mainland assets, also Taiwan assets, right? But we didn't see the large sell-off of Taiwan assets. So that means what made the global investors worried is still the China's own economic woes and the policy mistakes in the past 2 years.
Oh, that's really interesting. The differentiation between equity and debt is a pretty compelling piece of evidence that you've put together.
Yeah, when we talk to global investors, we do see people have a pretty different views. And the government money, be it a Canadian pension fund or Asian sovereign wealth fund, they became more cautious. Okay? There are later news stories saying that the Asian sovereign wealth funds are pulling out of private equity deals from China. But at the same time, we noticed the non-official affiliated money, like be it a long-only or hedge fund, they are a lot more opportunistic and are income-driven. They're ready to come back if they see a good data points.
So one last question for you before we wrap up, and I guess it's a continuation of this last one, which is broadly about geopolitics, because geopolitics, whether we like it or not, become an unavoidable part of macroeconomic research and analysis in recent years, particularly with the protracted tensions between China and the United States. So I'm curious, how do you see the potential for what the IMF has recently coined geoeconomic fragmentation, particularly in technology, impacting China's long-term growth prospects?
Yeah, unfortunately, it is happening as we're speaking. So it will have a very profound impact on China's economy and the global supply chain. There are a couple of things we can foresee. For example, we do see a lot of manufacturing capacities are moving from China to other countries by both foreign investors and the Chinese own companies. They're moving the factory not only to Vietnam, but also in Mexico. We see a very sharp rise in the FDI from China into Mexico to capture the opportunity provided by USMAC to avoid the tariff imposed on the export from China. Right now, China has become the number 3 provider of imports to the United States, behind North America and behind EU. So China is no longer the large export to the US anymore. So this has changed quite rapidly. At the same time, China's export to ASEAN is picking up very rapidly because China needs to export material, component parts to ASEAN. So China used to be the final assembly line for the global consumer for almost 2 decades. So that role is changing. So instead of being in the final assembly line, China is becoming a supplier of parts components for other countries to assemble the consumer goods for the rest of the world. So that is happening as we speak. So that will also change, I think, the China's domestic industrial structure over time. So I think we all need to pay very close attention to how China reacts to the U.S. CHIPS Act and also the Inflation Reduction Act. We know China's industrial policy has a mixed record. This is very successful in green technology, but failed almost completely in semiconductor sector. So right now, the research we found is that coming out of China is that in order to fight back the chip embargo, China have to build up the whole supply chain in the semiconductor industry. That means from silicon chips to the lithographic machines to the testing facilities. Even though China is not able to compete at the very high end in the chip sector, China can still make the low to medium end chips. It is the low, medium end chips make most of the money. Okay, chip makers have to make money from the mass market product to finance R&D of the cutting edge chips. Well, if China can eat into the profit of those sectors, it will have a huge impact on the global chip industry. So a lot of things will happen. We have to keep a very close eye on those developments.
Well, Gene, thank you very much for your insights today. It's been a pleasure speaking with you.
You're very welcome.
You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Please subscribe via iTunes, Spotify, or wherever you get your podcasts.